Hi, and welcome back to our Markets Insight video. Now, last week was dominated by geopolitical headlines, sharp swings in sentiment and renewed volatility across currencies, commodities and equities. In this video, we'll break down what moved the markets, look ahead to the key central bank decisions and highlight the stocks and events to watch in the days ahead. So firstly, what happened in the markets last week? And let's take a quick recap. Now, markets turned sharply risk off early in the week after President Trump threatens tariffs of 10%, rising to up to 25% on key European partners over Greenland. This sparked a so-called sell America trade. Equities in the US dollar sold off, volatility jumped, and gold surged as investors priced in rising geopolitical and trade risks. We'll take a closer look at the market reaction a little bit later on in the video. By midweek, sentiment had improved a little bit after Trump walked back the tariff threats, stating that duties planned for February the 1st would not be imposed following talks in Davos and the announcement of a tentative Greenland framework involving NATO. US markets recovered most of their earlier losses as risk appetite returned. Gold hit fresh all-time highs during the initial flight to safety before easing back slightly by January the 22nd on profit-taking and signs of de-escalation. Now, despite the pullback, prices have remained elevated. Some analysts believe markets will eventually learn to ignore Trump's comments. However, this seems a little unlikely. With a wide range of participants and a constant need for corrections, such headlines can easily be used as catalysts for sharp price swings. Now, let's look at what events, besides the geopolitical risks, can trigger price volatility this week. Right, so this week first up is central bank meetings, and on 28th of January, both the Bank of Canada and the Federal Reserve will announce their interest rate decisions. Now, whilst rates are expected to remain unchanged, these events could still lead to some notable market swings. The Bank of Canada is expected to keep its policy rate at 2.25%. However, its quarterly monetary policy report will be closely watched for updated inflation and growth forecasts, as well as the bank's assessment of general economic risks. While the meeting is unlikely to reverse the broader Canadian dollar trend, it could drive some intraday volatility. The Federal Reserve is also expected to keep rates unchanged in the 3.5% to 3.75% range. The focus will be on the press conference, of course, where clues about future policy path may well emerge. Now, the US dollar came under pressure last week, as we've mentioned, opening with a bearish gap after weekend comments from Donald Trump. He said that a 10% tariff, which could rise as high as 25%, would be imposed on all goods shipped to the US from Denmark, Norway, Sweden, the UK, France, Germany, the Netherlands and Finland from February the 1st, unless they allowed him to seize Greenland. Now, on Tuesday, the dollar index dropped around 0.9% within several hours, its largest decline in over a month, as markets embraced the sell America narrative. US equities fell and the dollar weakened broadly against the other major currencies. So rising risk of trade wars, NATO fragmentation and a potential recession temporarily undermined the US dollar's so-called safe haven status. As a result, the dollar index broke below the upward channel that had been forming since late 2025 on the 4-hour chart. Now, although the index subsequently recovered, it was short-lived. A strong resistance zone in the 98.80 to 99 the figure range prevented it from returning to that previous ascending channel. Okay, now before we wrap up the macro picture, attention now turns to corporate earnings. And this week we have 4 of the so-called Magnificent 7 companies reporting their earnings. Now, potentially this could drive volatility in major US indices such as the S&P 500, the Nasdaq Composite, the Nasdaq 100 and the Dow Jones Industrial Average. So, who is reporting? Well, we've got Microsoft, and that'll be closely watched for cloud growth trends, along with commentary on AI monetization and enterprise demand. Given its heavy index weighting, Microsoft's guidance could significantly influence broader market sentiment. We've also got Meta platforms, and they'll be in focus for advertising revenue trends, user engagement across its core platforms, and cost discipline. Updates on AI investment and margin impact are likely to be key drivers of the post-earnings reaction. We've also got Tesla, and their earnings will be evaluated through delivery volumes, automotive margins and pricing strategy. Any signals on demand conditions, cost pressures, or progress in AI and autonomy could trigger heightened volatility after their earnings. And finally, Apple. Apple's report will offer insight into iPhone demand, quite obviously, services growth and regional performance. Forward guidance and commentary on consumer spending will be critical in that earnings report. Last Monday, the S&P 500 opened with a sizable bearish gap following weekend geopolitical developments. The index briefly fell below the lower boundary of its upward channel before rebounding from December 2025 levels. This week, geopolitics and earnings reports may well be the key drivers of direction. 6,950 and 7,000 levels could be significant resistance levels. But to sum it up, this week is all about geopolitics and macro risk. Any fresh developments related to armed conflicts or trade tensions could quickly impact currencies, commodities, equities, which have their own earnings reports, of course, and indices. For real-time updates and in-depth analysis, make sure to check out the news and analysis section on the FX Open website. And I think this week your risk management techniques may well need to come to the fore. Thanks for watching, and as ever, we wish you luck with your trading in the week ahead. Bye for now.